what's your sense here? I mean, chalk and cheese per se, but related in some sense because they are consumer facing. And these guys have had problems of their own. Uh, but I mean, the valuation multiples coming down because of extraneous factors notwithstanding. Internally, a bunch of technical factors like supplies coming in because of the lock-ins getting over, resignations at a lot of places because people are seeing newer ventures, and, and possibly a bit of a slowdown hitting the streets as well. What's your sense on the platform companies?
Yeah, sure. So let's say as a business analyst, I try and focus first on the last part, which is the business, which you just said. And I guess it's a combination, in fairness to the companies, which is that the private equity stroke private participants would decide with the company and the merchant bank to call the company what is called IPO ready. So a company is IPO ready when it has a certain revenue traction and has reached a certain stage, right? The unfortunate part as a function of that, without the overlay of pricing and valuation, is that is also the point where the easy game or the easy growth has been had, whether it is 5 or 10 years of very, very sharp and rapid growth. Whether we look at a company like Zomato or Policy Bazaar or Delivery, Paytm and Nykaa. These are the 5 which stand out in my head in terms of the big sort of consumer tech companies which are listed. So, and then each of these guys would take a journey as a public or a private company. But once they are IPO ready, they've been got in at a certain size of revenues. And related to that is the growth opportunities, clearly, right? Now, if you were to mark, and they're all very distinct companies, from fintech, and insurtech to food tech, etc. They each of these companies, barring maybe a one odd name, have actually attempted to take on one large acquisition or grow into 2 or 3 new related categories, such as fashion by Nykaa. Obviously the Blinkit acquisition stands out for Zomato at the top of my head. And Policy Bazaar trying to probably do BNPL or some loans, etc., which are not part of the original feature. As growth in the core reaches a certain traction and point, which we made, and then they need to work towards growth. For us as prospective investors or existing investors, it would be in some sense to say, because the valuation is sort of driving you, because you put it out at that numbers, that you need to sort of now do, jump a lot of hoops to be able to justify that. So I think it's an interestingly poised situation right now, where you were IPO ready, you got yourself listed. Turns out now, my point on valuation, that the markets obviously were very hot, or you were very opportunistic. That is the point where you said that for extraneous factors, which is just an attribution saying, hey, the US tech fell by 40%. So even our valuations after listing have come off there, which is fine and acceptable because these are markets. But they obviously priced it, to the last dollar or last rupee left on the table. Investors were excited at the early stage, but we're clearly now down 30 to 50% each of these names that I called out. And not that they are looking like a sort of a screaming buy as such, on the point of growth and the business model itself, right? So none of these companies are reporting sustainable cash flows, which will meet their current, their current sort of expectations on growth, or their desire to fund a lot of this growth. So either they are sort of barely EBITDA break even, or they're losing money at the EBITDA level, which in the past would have meant, the next round of funding and an external funding that would have come in. Now that they're publicly listed, the challenge would be that, they would have to have sources of funding. It could be a rights issue, it could be pref allotment, etc. But that is the challenge. That is the challenge for these guys now. And thus the hurry to sort of reach a quick sort of break even at EBITDA level so that they're not burning capital. and whatever capital there is in primary or came with the historical capital, they'd use it much more efficiently to try and build these other additional businesses on top of the core business that they have. So I would say, after a long sort of answer, that very interestingly poised these companies are. And each of these will have, I think, unique sort of journeys. We'll have to watch them more closely. I guess, who would not want a 30-40% discount to where they started with, which kind of opens up our interest to look at these names.